Welcome to Disruptive Capitalists, the show where purpose-driven entrepreneurs and bold investors share how they're reshaping the world by investing time and money in a way that improves lives and creates wealth. So let's get to it. Everyone, thank you for joining us again today for another great episode of the Disruptive Capitalist podcast. Today, my guest is Steve Selengut, who is a 40-year plus professional investment manager, advisor, RIA, whose current adventure is coaching both individuals and other advisors in creating income independence for themselves and their clients. He's also on his second book, Retirement Money Secrets, where he talks about being an investment manager for over 44 years and managing over 325 individual portfolios in the USA and abroad. Steve, thank you so much for joining the show.
Oh, my pleasure. Nice to be here.
So 44 years in the investment world. Tell us a little about that. A little bit about that.
It's if you count when I started from my own account, it's really more like 55 years.
Wow.
I started investing when I was 25. So I developed a way to focus on the income being produced by the portfolio. Mm-hmm. And I did it through dividends on the shares, on bonds like municipal bonds, corporate bonds, preferred stocks, things like that. And I also traded, and I traded a lot, and much more so, I guess, than a lot of people thought was appropriate back in the day. But my broker and I, we looked at the charts, and you could see that the best companies were volatile and their prices would be going up and down. And it wasn't a matter of timing or anything. It just, when you went in, you bought the ones that were down in price in their cycle. And then you set a target instead of just watching them go up and down forever, like most people do. You set a target and said, okay, after 10% after commissions is my target. So I had to wait for them to get up around 12% before I'd sell them, and then we go and we'd find something else that fit the bill. And when you looked at the New York Stock Exchange, and I only traded on the New York Stock Exchange. I never went on the NASDAQ or anything else, and no mutual funds, no IPOs, none of the junk. And when you look, there's over 200 dividend paying stocks that at the time were rated by S&P B plus and better, which was their what they called investment grade. Have you ever seen the S&P stock guide?
I have.
Have you? Mm-hmm. They stopped publishing it some years ago, but at that time, like I said, there's over 200 stocks that we could trade, and we did so successfully for years. And then when it was 1979 that I decided that, I'm making so much more money than I'm making in my job. And I'm commuting to New York, and I have all these three-piece suits and other garbage to worry about. I don't need to do that anymore. I can find some people who want to make the kind of money I'm making from their portfolios. And I did, and I started my own IRA back then and started the business. So from that time on, it was just spreading the word. Hey, people, you can make more money doing it this way. And then in the 90s, I discovered closed-end funds. And by the time, just after the financial crisis, I was totally converted into using closed-end funds for income and for trading. And that's what I'm still doing with my own portfolio and teaching other people to do that as well. The book, Retirement Money Secrets, that you can see over my shoulder there, is that's what it's focused on. Teaching people how to achieve income independence from the income they receive on their investments and trading those investments to produce even more income.
So if somebody's listening right now and they're thinking, I want to go look at that book, Retirement Money Secrets. But if there's anything that I could do right now today to create that independence so that I can retire and be free, what would that one thing be?
Well, you have to change your focus, really. You have to change your mindset and say, I don't really, I've got this portfolio and it's full of high quality securities. I don't really care what the market value does. What I care is how much income it produces that I can spend if I choose to, and how it keeps that income growing over the years. So it keeps up with inflation, it keeps up with my needs, allows me to take care of my kids, allows to take care of my old age and all that stuff. So it's all a matter of mindset. You can focus on the growth in market value, or you can focus on the growth in income. And you got to switch that focus from market value, which they say market value fuels the ego and income fuels the yacht. That's what it says on the top of the book there, that
Yeah.
line. And it's so very true. So getting your investment advisor or even your stockbroker, I guess, when you start telling them, hey, I want to talk to you. I want you to find all these income securities for me. What do you got? Or, I don't want your model portfolio that pays me 1.5. I don't care if I own a fractional share of Berkshire Hathaway. That doesn't interest me. What I
Right.
want to have is something that pays me income. And I know there are, of course, closed-end funds. There are ETFs that pay over 10%. There are some mutual funds that pay 7%. There are BDCs, a little bit more risky, but they pay that much. Master limited partnerships, they have their problems. There are REITs, and on and on. And I know you can buy those for me, and I can make more income. That's what I want you to do. So you got to get to that point where you have to take care of making your money work for you as hard as your employment does. And you have to get somebody. You got to get, if you're working, you don't have the time. So you got to get your team member, your advisor, your broker to do it for you. And then you got to tell them, I'm paying you, 1.5% for this. I want you to make me this money. I want you to make me more profits than I'm paying you in fees. So that's
Yeah.
that's pretty much what it's all about.
I remember as a young man, a man who had done very well in the stock market and done very well with his investments taught me a very key principle, which is what you're really bringing up, Steve, is like that point where your passive income exceeds your expenses is freedom. That's
Right.
the freedom point. That's the point where you get to make decisions, a decision point, freedom point. It's not being free of debt. It's your passive income overtakes your how much you spend for your daily life, for your wants and needs. And we get so focused on, oh, I want to be a millionaire. Like people talk about that all the time. You don't need $1 million. You need $5,000 a month or 10 grand a month. That's what you need. You don't need $1 million. Now, $1 million can help you get 10 grand a month or 5 grand a month or whatever, but it's not, it's the income, it's the cash flow coming to your bank. And that's really, I mean, that's what you're saying here is people got to change their mindset from chasing the money, the numbers going up and focus on that income. It's
Right. Exactly. And my approach can be passive.
mhm.
If you just buy the closed-end funds and they pay you right now, the income ones are paying over 10%. The stock market-based closed-end funds are paying over 9%. You won't believe this, but the tax-free municipal bond closed-end funds, there are 49 of them that I invest in, are paying an average of over 7% tax-free, federally
Wow.
tax-free, and there are 6 different states that have tax-free munis that are paying that much. It's crazy, and nobody seems to pay much attention to them, which I think is funny. But you can do it passively, but I take a more active approach. because when you look at the volatility of these, and they're very interest rate sensitive, of course, because of their yields, but their price range is very narrow, unlike common stocks, unlike the stock market. So you can actually trade in a 5% range and add significant profits to the significant income you're getting. So that in some years, in this, for example, in this year, I made, almost an average of over $200 a day in profits. While the income itself that's being generated is 10%.
Wow.
So it's a different route. It's not anything new or crazy. It's closed-end funds have been around earlier than mutual funds, 100 years before ETFs. So
yeah. So why don't they teach this in school? Like, why don't kids coming out of high school do this? I mean, think about that compared to Social Security.
Yeah. It's a big difference. It's like the annuity that you pay for your entire working life versus taking a part of that income and producing a stream of income for yourself. Yeah, I mean they don't even teach you how to balance a checkbook. Come on.
Yeah,
in our education system. So you're not going to get it in high school. Unless somebody you get some department to take that book and pass it around to its professors, but you're just not going to have it.
I'm not going to have it.
No, and the problem is in the financial community is ever since we stopped being commission based, and it was okay. Independent advisors were always based on the market value under management, but the brokers themselves were getting commissions. So when you told a broker you wanted for this particular client, you wanted to buy a bunch of municipal bonds, he was fine with that because he was getting the markup on the bonds. But when they changed the brokers to be paid on amount under management, then that changed their perspective. And it changed the company's perspective because they only made more money if they grew the amount under management, the AUM. So income-focused securities are not killer stocks. I mean, they're not going to be a Microsoft. They're not going to be an Amazon. They're going to be slow and steady. They're going to produce the income that you need, but they're not going to go up in market value significantly and make you feel rich. Nor are they going to produce the AUM that your boss wants you to show so that they can chart, that's what they're getting paid on. So that's the big change I think that happened. I saw that happen because I was the fee paid guy and my broker was the commission guy, and he said that I was trading too much and it's making him look. I said, but you're not churning the portfolio. You're just doing what I tell you to do.
Yeah.
So you're not in any trouble. Yeah, well, compliance doesn't look at that way. And then finally we changed when it all went down and we were all getting just a piece of the action. You saw the change in perspective. And when I sold the business, think about it, I was managing 110 million in capital, and I was generating the portfolio itself, 2021. I sold it in 2023. But in 2021, we made, like $7 million for our clients in distribution income, but we made another $7 million in profits. So it was like 15% on their money,
Wow.
So, and so when we sold the business, and it was good timing because we were both getting old, and so we sold the business, and they were impressed with our amount under management. So I was talking to my broker. I said, well, you got to tell these guys what they're getting. We're making more income for our clients than anybody else. Nobody is focused there. It's a whole opportunity where they can create an entity that focuses on income instead of just chasing this market value. And the response was pretty much, frankly, Scarlett, we don't give a damn, We don't care about that. You better keep that AUM up there so that we pay you the rest of your payment next year. And if you
Yeah.
don't, we're going to pay you less,
Yeah.
That's all they cared about
Those fees, right?
is the AUM and the fees they get. They clearly were not acting in a fiduciary capacity when it comes to their clients. And when you think about it, when they say that they're doing what's best for their client, they're not asking their client for the client's opinion. They're saying what's best for the client, not the client.
Right.
It's strange that it's a problem. I think that the financial community has come to that, and I don't think it's certainly not the brokers that have made that decision. It's the managements of the huge companies now that control it all.
When you think, the response you have to have to your shareholders, the pressure you get to maximize return, right? And
Return, yeah.
if the return you're talking about is only in the terms of dollars, and you're set to maximize that return, then you're taking out humans. And when you take out humans, it becomes a cold and or misaligned system.
Yeah, I feel that way. And part of what we're trying to do with this community that we've developed is to create as many hundreds of people as we can who have this income focus, and they've either left advisors to do it themselves or they do it themselves. Can they now do it themselves, or they're taking on advisors, but they're vetting them by asking them these questions. These are the income securities I want you to put in my portfolio. I want you to trade them at reasonable profits. I want you to make me more than the 4% I'm going to be taking out when I retire, and I want you to be making more in profits that I'm paying you in fees. And that's really pretty simple for someone to achieve if they put their mind to it.
If they put their mind to it.
And it's so funny because as we were saying earlier, everything they invest in, all the companies that they invest in, all the top seven, all the big companies, the most important thing that keeps those companies running is cash flow. Cash flow. It's all about cash. You don't have cash flow, you get out of business. So that same cash flow principle can easily be applied to the management of a portfolio. A portfolio, in a sense, is really just like a department store where the companies you own represent manufacturers of businesses or manufacturers of products or providers of services. And you're setting you own them, and you're setting a profit taking goal for them. And when somebody comes in the store, you sell it at that profit. I mean, my maximum profit, if I get any closed-end fund that's as high as 5%, that's in must-sell territory for me. Mm-hmm. Because it's a fund, so it's not going to have the individual increases that stocks do. But still, I'm typically selling a security that I bought this morning. If it's an up day, I might be selling it for 1.5%, 2% profit the same day. So it accelerates the compounding of your earnings to the point where your income is growing way beyond the rate of inflation.
Yeah.
Even in recent years, inflation.
Your income is growing.
Your income is growing. The stuff you could spend if you wanted to.
So I like a phrase I heard a long time ago that kind of stuck with me is, you can't even buy a sandwich with equity. You need cash.
That's right.
And so nobody cares how much you're worth if you can't you don't care how much you're worth if you can't buy a sandwich.
Right. Don't go into a store and try to throw a gold brick on the
Yeah, yeah.
They're not going to take it. They're
Don't
not
you
going
know
to
how much I'm worth? Like, they don't care. Like, where's
they don't
where's
care.
the cash? So, we have a massive amount of the population retiring in the next handful of years. Supposedly retiring. I don't think a lot of them are going to retire. They're going to have to work because Social Security is not there, is not sufficient, or the cost of living has gone up so high.
Right.
Pick your reason. There's going to be a lot of folks who, particularly those who are retiring, who could definitely benefit from listening to you and reading your stuff. So how do they get a hold of you?
Well, the book is on Amazon. So it's all four types. They can read it, they can listen to it, they can flip through pages, or they can do it on their iPad. However they want to do it. And the name of my website, The Income Coach, it's theincomecoach.net. So that's easy.
Easy.
And the book gives them all my contact information, including how to get involved in the community. And the community is an educational community that will bring them up to speed on how to achieve their income independence.
Well, thank you so much, Steve. I really appreciate your focus. I really appreciate the fact that you, calling out your colleagues that are focused on the wrong things and they've forgotten about the humans involved, which is really, capitalism is only so good as far as it helps us become better humans. And I think, there's probably tens of millions of people that could benefit from your sage advice. And hopefully those listening sign up, go buy the book. I know I'm going to send that book to a few people right now. And thank you so much for being on the pod.
Okay. My pleasure.
If this episode shifted your thinking, then share it with someone bold. And remember, capital is a tool. Use it to build a world you are proud to live in.